Let's talk about power sector. That has been in focus when we've seen all these power stocks actually buzzing away in trade, almost near the 10-year high. Valuations have peaked as well. But, what's the story now playing out for the power sector? Nikhil Nigania is joining in with us, Director and Senior Analyst at Bernstein. Nikhil, very good morning. Thank you so much for joining in with us. And Nikhil, I want to talk by starting about the past up cycles that we've seen versus now. When you differentiate in the past upcycle, obviously there was problem about shortages across different time periods, not a specific time period. Other than that, obviously in terms of investments that were made, there were not too much investments made in the power sector in the past upcycle. Now it's a different story this time. So when we have to pick out the winners in the power sector, what is going to be a different story this time? Where should one be looking in the power sector?
Thank you for having me on the show. So if we compare the last power cycle, which went up right till 2012, versus the current cycle, which started, I would say, a year and a half back, the primary difference, as you said, is last time there was consistent power shortage throughout the day because we did not have enough private sector participation. It was largely state-owned enterprise who was setting up power plants back then. And this time around, while the private sector participation was strong earlier, now we have a unique situation where due to addition of only solar capacity, largely solar capacity, we have shortage in the non-solar hours of the day. So it's very specific to a time of day power shortage that we have, which is happening. And secondly, at the same time, we are doing energy transition. So we are doing energy transition and also solving for non-solar hour shortage, which is leading to a power cycle this time. In terms of the winners of this last cycle versus this cycle, so the last power cycle, the biggest beneficiary were the early entrants, and that too early entrants who had merchant power capacity. For example, Jindal Steel and Power last time had a merchant plant which came very early in the cycle, 2007-8, and they were able to make the largest returns given they were early and there was a massive shortage and they had power prices as high as 7-8 rupees on the exchange back then. Then we went into a surplus phase for almost 5-6 years, 2015 to 20. And now we are again into shortages. So this time round as well, typically in power, the entities with merchant power capacity stand to make more gains than others. So that's one category of winners. The second category of winners this time would be players who are still open to investing in thermal capacities, because thermal is very important to solve the non-solar problem of India, where our company in coverage NTPC comes in, which is our top pick in the sector, which is going to add, we think, both thermal, renewable, and even participate in hydrogen.
Nikhil, but the point is that power stocks, and I'm purely talking, in terms of shareholders right now, they've made some phenomenal returns, right? And yet you always question whether the price that you're paying right now, the valuation, justifies the growth that these, companies are going to post. Do you think that while you can't really point a fault here, the stocks have run up ahead of the fundamentals or not quite?
No, fair question. So see, sector thematically, we think the sector should be positive for a medium term. The power shortage should continue in medium term. But valuations, yes, I think they have run up quite a bit. But there are, so one, I think investor needs to be selective right now. One can't do a broader play. And there are some names like NTPC which have still not reached the last cycle peak valuations yet. We don't think it'll get there. Plus, we don't think investors should from here expect the kind of returns they saw last year. It'll be a more gradual return and a slightly more longer story from here.
Nikhil, hi, morning. I wanted to understand your outlook in particular then as to how we're looking at a renewable surge then in the year ahead. Do you think that as we're seeing solar costs plummet, what is the outlook then when it comes to renewable projects that are in the pipeline, that have been tendered so far, and what the year ahead spells for it?
Sure. So renewable sector, see, it's largely impacted by three things. One is the module prices, which are at it's the lowest point in history. Module prices have fallen to 12-13 cents from as high as 25-26 cents during the COVID years. And second is interest rates, which are expected to come down. And the third is the market size. So it's been a very competitive market for renewables historically, but now the market size has expanded and the competition is relatively lesser. So all these three aspects points to a very positive year for renewables that ways. And for developers especially, it looks like a positive year. For the manufacturing companies though, the companies manufacturing solar panels, we are still not very certain. We think there's a supply glut coming. So we don't think that's the best business to be in. But solar developers, it looks like the perfect setup. Falling interest rates, falling module cost, increasing market size. So we should see large capacity additions also happen this year in renewables. All of that, which got paused for a couple of years due to high module cost, and better returns for the sector as well for renewable companies. Is literally the perfect setup, I think, which could have happened for them. Yeah.
Surely a year for renewables, but when you talk about the sector as a whole, do you think that this is just the beginning of the upcycle, or because like I was reading the note that came in also that you're still expecting that power shortage to continue this time in 2024 as well. So could we say that this is just the starting of the upcycle, or maybe now it's time that we would see a pause here?
Exactly. So from a sector perspective, see, the thing that happens in the power sector is once a power shortage starts, for it to go away is not easy. Because all of the solutions to the non-solar power shortage are long gestation projects. To add a new thermal plant, it takes 4 to 5 years. To add a hydro plant, it takes 10 years. Similarly for nuclear as well. And even for a pump storage plant, which is being talked about a lot, it takes 6 years. So once a shortage starts, which it has started since last year, it's not easy to take it away. So unless power demand disappoints, which also doesn't look like it'll disappoint this year, given the average temperature globally is expected to be high again this year. So the cycle from a sector perspective definitely should last a few years. We don't see it going away. But valuations, as we said, more gradual up from here rather than the kind of return we saw last year.
Nikhil, since you just briefly touched upon pump storage, the last time we were chatting, I recall you calling it the AI of the sector. Does it continue to hold that status according to you?
I think the market does associate it like that almost. So any company which is coming and signing an MOU on pump storage, the stocks are reacting immediately. See, as a solution, we think it's a brilliant solution. It is much cheaper than batteries. The life of a pump storage plant could be up to 100 years versus a battery which does like 5 years and then 5-10 years, and then we have to replace it. So from a solution standpoint, it's excellent. But we have to remember that the companies which are signing MOUs, the plants will come after 5-6 years. The plants, you won't see the earning impact right away. So good solution for the sector, but earnings impact still quite a way. And there also, I think the early entrants would be winners. So there's a private company called Greenco, which saw this problem coming back in 2018. And since then, they have been in the process of setting them up. So companies like those stand to gain the most in such a situation.
What is the right way, given the valuations that most of these stocks are currently sitting at, to get a piece of the power play? Because, all companies have pumped up their investment across the entire space right now. Could we look at, say, some of the capital goods / industrial plays? Is that the new way to approach power, maybe?
So you're right. So there are 3 ways to approach it. One is the capital good names. Second is the power financer, and third are the utility companies. So the nearest term gainers are usually capital good companies. So for example, transformers is currently become a bit of a bottleneck for the industry, is what I'm hearing from developers. Access to transformers is taking longer. So hence equipment demand and the capex cycle in power should definitely drive up the capital good names. But we don't cover them, but the valuations definitely prima facie look higher. Second are the financiers. Financiers again have rallied as well. But there we see more visibility on loan book growth. We see very low risk of NPAs happening, given renewables are a much safer investment that way from a developer standpoint than a thermal plant, which is much riskier, takes longer, has more moving parts. So finances, I think, are in a good setup as well. And third are utilities, which are the likes of NTPC, which we cover, and NTPC we like. Between these 3, while all 3 will gain from a valuation standpoint, and we prefer the NTPCs of the world and possibly power financiers over the capital goods, largely because of the valuations. Yeah.
Just one last thing I want to know is in terms of merchant powers, is it the best play in the upcycle? Is merchant power the best to own, in terms of the better cash flow that they have? So is that a best play in this upcycle then?
Almost all power shortage cycles, ideally the guy who makes the most money is the person with a merchant power plant. The same thing happened with Jindal Steel and Power last time, which we don't cover. But this time around, there are a few entities who have merchant power plants. JSPL, I think, has moved the merchant plants to the promoter from the listed entity. But entities who have merchant plants, they can make the benefit of the high power price on the power exchange. So average price on the power exchange right now are 5 rupees, but they can go as high to 8 or 10 rupees in the non-solar hours, or especially in the summer months. So the plants with long-term PPAs, they can't benefit from that. But entities who have merchant capacity, untied capacity, they are the ones who can benefit from the high power prices in the short-term market.
Okay, Nikhil, thank you so much for joining in with us this morning on ET Now, giving us a roundup in terms of the power sector as well. It's always a pleasure having you on the show. On that note,